Good morning, everyone. It is the morning of March 5th, and the markets will open in about 30 minutes. I thought I'd have a live stream to talk about stock investing. As a active long-term stock investor, I am on the market trying to figure out what's this market going to do. Is it going to move from one sector to another, which has been fascinating to watch, and it has been the case. We've seen stocks move in from technology and consumer discretionary over to other industries, other sectors like healthcare, consumer staples, and others. So just trying to position my portfolio to outperform the market in 2025. And it's good to live stream, good to collaborate with other investors so we can determine what's the best path for our stocks. And what I'll do is open up with some comments on some news items that are affecting the market and how they'll be moving the market this week, this month, this quarter. And then I'll get into some individual stocks that we'll take a look at. If you have a stock that you want to look at, please put it in the chat. I see some messages coming in already. Thank you. And I will take a look at those symbols as time allows. So I had a couple of stocks that I wanted to look at as an opening, and then we'll take a look at your stocks. But please put them in the chat, and I'll take a look at them. So I wanted to start off with the state of the economy and, in essence, what's going on kind of at the macro level. We have a lot of changes as it relates to tariff policy. And I think the tariff policy it's just changing, right? So it's not like we have a quarter of data, but it's expected that the tariffs are going to disrupt certain industries and really change how, for example, the automotive industry is going to adapt. So I think the changes are going to be quite dramatic. Now, a report that I saw yesterday that caught my attention was I was actually viewing The Compound, which I find to be interesting because they usually put out really useful information, and they put out a really useful chart that I'm sharing with you, which is this is the GDP forecast, and this came out of the Atlanta Fed. And for that Fed, I think are they presidents? The presidents of that region, they believe that for the first quarter of 2025, there's going to be negative GDP. That's bad. If we have 2 consecutive quarters of GDP contraction, then we're in a recession. So to look at 2025 and look at GDP contracting, that really caught my attention. Like, hold on a second. If we go into recession, the stocks are going to really be, or I should say investors in stocks are going to be more fearful. They're going to be more cautious. So that was a bit of data that should be taken into account, and I'm going to monitor GDP growth going forward. I'm really looking forward to the next Fed meeting and see what they're going to announce in this respect. Now, related to that report I just shared, in this report, I don't trust as well, or trust is the wrong word. I take it as information, but I don't put too much stock into it. And the ADP employment report, this report basically saying how many new jobs were created, and it was expected that 140 jobs were going to be created. And they reported no, only 77. So there was a reduction in jobs created. So that is one more piece of data that says, hey, the economy is slowing down. Okay. So if we get into a recession, I think we're going to be dealing with just one more big factor keeping stock prices down. So that was interesting, and I'll see how the evolution of this economy is going to go. If we're in a long-term tariff war, it usually means there's going to be pain. There's going to be pain in the form of unemployment. There's going to be pain in the form of slower economy for a period of time. And those are just economically what I'm expecting. And it may be a long-term win, the whole policy, but short-term, it's probably going to hurt stock prices. So that's, in a way, an opportunity. We can always be optimistic about what's going to happen. When we look at stocks, the stock market itself, we have the NASDAQ that is down for the year to date, but from the high to where it's at now, it's down 8.83%. And it did touch correction territory yesterday. And I caught the moment and I put it on Discord. I put it on X. It touched 10%. Once this index goes down by 10%, we're in correction territory. So I touched it yesterday. If it goes down today, we're not that far away from 10%. The Russell's already there, I believe. If we go into the Russell, it's in correction territory. From the high to the low, it's down more than 10%. Smaller stocks tend to sell off when investors are more concerned. They want to play it safe. They want to go to stocks that are more recognized. They don't want to go to small companies that are less known. So that's what's going on with the Russell. The S&P is holding it together a little better. It's down about 6% from the high to where we're at now. Now, this correction that we're in, right now it's a pullback, but if we get to minus 10%, we'll call it a correction. If we get below, I believe 20 or 25%, we call it a crash. So now, as we go through this process, what's the big story that's going to change the course of stock prices, right? And I don't think we have a big positive story. We just have stories that just add a little more concern. And the concern around, okay, we got a tariff war that is just starting. And then we've got some disruption at the federal government level. And I think that might prove to be maybe a good thing if we reduce the cost of the federal government. But it's just very disruptive. It's causing a lot of job losses. So we'll see. We'll see how stocks move. The other factor out there is, technology's done great. Semiconductor flourished, just was phenomenal how it appreciated. But some things that, when we look at sectors, and here are the sectors, right? We have 11 sectors total. Here's technology. This is where semiconductor is. This is where software companies reside. And it's down 5%. And that tells us part of the story. If you look at semiconductor, it's down even worse. And that's where NVIDIA, TSM, Broadcom exist. Now, semiconductor is a cyclical industry / sector. What does cyclical mean is you have periods of growth like booms, and then you have periods of contraction. It's cyclical. And we saw a phenomenal growth period. And we're also seeing, married to, the semiconductor companies are feeding the data center build out. And the data center build outs are occurring. But the stock market doesn't like the fact that the big companies that are putting a lot of capital into the data center, for example, AWS, Microsoft, and Google, it's selling off their stocks, saying you're spending too much capital. So I think that's going to have an impact on those stocks, and they're going to lower the amount of capital they're going to spend in that data center, which is going to lower the revenues for semiconductor. I think that's going to happen within 2025. I think you're going to see the change, and it's going to affect 2026. So that's been really interesting to witness and look at. Discretionary income, consumer discretionary also is taking a hit, and that tells me that the economy is slowing down. Consumer discretionary is going to do well when we have a very good economy and sentiment is positive at the consumer level. And sentiment is not positive right now. Sentiment is a little worried. There's concerns out there. So consumer discretionary is seeing a pretty substantial pullback. So that is interesting there. On top is healthcare, and that's a combination of that sector hasn't done all that well for a couple of years. So there is a lot of upside potential because it was so discounted. And secondly, healthcare is not bad. If you go into recessions, healthcare continues to perform. People continue to go to the doctor, whether it's a good economy or a bad economy. If they're sick or they're ill with something, they go to the doctor. If they need to go to the hospital, they go to the hospital. It's not an economic decision. It's a healthcare decision. And then consumer staples are showing up. It means that investors are a little concerned right now, moving over to something safe. Real estate's doing well, materials and so forth. So that's what's going on macro level, and kind of zeroing in on the most valuable companies. Apple is, I would say, somewhat holding it together. It's only down 6% for the year. Microsoft, not so well. I commented that they're spending too much on that data center, and I think the market does not like it. You're lowering the amount of free cash. I value companies based on the free cash flow I expect the company's going to produce in the future. I saw a really good interview of Bill Ackman. That's his principle. That's how he values companies. And he learned that from Warren Buffett, who learned it from Benjamin Graham, who wrote a book like 100 years ago. The concept is not new. It's just very tried, tested, and proven. Free cash flows is the valuation method that will give you long-term success. Microsoft's lowering the free cash flows, so the market is saying, we don't like you as much. Amazon, we don't like you as much. You're spending too much capital. Google, we're putting you in the penalty box. We don't like that you're spending a lot of capital. So consistently, all three of the biggest cloud operators in the marketplace are being sold off. And I think they're going to see the writing on the wall, which is, we may think we want big data centers strategically, but we need to listen to our stockholders. And Microsoft already began to message that, hey, we're going to start leasing, capacity, compute capacity versus buying it, which is a move away from putting more capital in the data center, which was a positive move. So that is what's happening with the biggest, most valuable companies out there. Meta went from 25% gain in 2025 down to 9%. It's really sold off in the month of February and even into the month of March. Berkshire has been going up. It's been going up the ranks. It was like out of the top 10 going into 2025, and now it's number 7. Broadcom is falling big, down 19%. And I think it has more ways to fall. Tesla is just getting crushed, down 32%. Owie. All the Tesla fans, all the Elon Musk fans, where are you? Tesla is like the Taylor Swift of stocks. Everybody loves Taylor Swift. I can't name you one of her songs, but if she's performing, I think she's great. Tesla is like one of those stocks where it doesn't matter that they don't make a whole lot of money. It doesn't matter that car sales are going to be terrible going forward. And they have competition from all these different places for car sales. Doesn't matter, man. They're a technology company that's going to change the world. Well, we'll see if that happens, but their fundamentals tell me a different story. And I guess the fundamentals are beginning to bring down the stock price for Tesla. Eli Lilly is going up the charts. This is a healthcare company. They're up 18% year to date. Healthcare is doing well. TSM's going down the ranks. They had a great day yesterday, but still, I think this one is overpriced. Walmart is a safe stock. A lot of people know Walmart. It's a retailer. I own Amazon, and this is new school. This is where people are buying and they're growing organically, their e-commerce operations. So Walmart is a legacy company. It is an old school company. They own they operate big retail locations and hire a lot of employees and sell product that's predominantly made in China, by the way. The tariffs are really going to hurt them. So I'd rather own Amazon, which I do. JP Morgan doing well for the year. They did have a pretty tough pullback yesterday. Visa, really consistent operator. The biggest energy company, Exxon, it's just flat for the year. Costco's up nicely. This is kind of a safety stock. Another one that a lot of people know Costco. They like owning Costco because they know what it is. When I value Costco, it's well above its intrinsic value, meaning it's overpriced. So we shall see. United Healthcare, another healthcare company, Netflix, and then Procter and Gamble. So you can see that there's a lot of red here, especially on the year to date. And it's a rotating out of these big stocks, which is more technology, right? Technology. This is a combo e-commerce technology company, technology, right? So you've seen a big rotation, and that money is going to healthcare companies. This is up, staples, real estate, materials, and also bonds and cash, right? Now, whenever I say bonds, I usually get a reaction from stockholders. They're like, hey, over the time, stocks will outperform bonds. I completely agree with you. But I don't invest, and walk away for 40 years and say, okay, whatever happens, happens. No, I'm managing my portfolio. It's like being a farmer and you're like, wow, the weather looks terrible. I better not plant seeds because it's supposed to rain for the next 2 weeks. We're supposed to have really cold temperatures. It would be unwise to plant seeds over the next 2 weeks. Similar, hey, the markets are telling me that we have a rotation going on. So maybe I can park some money for 6 months, 12 months in a bond ETF, make 5%. It doesn't go down in value. Actually, bonds have been going up in value. So maybe I have a total rate of return of 6 to 8%. And I don't have a rate of return where we see some stocks, like let's say a nice safe stock like Apple, you lose 6%. Well, heck, if a bond's going to make 6 to 8%, the differential is 12 to 14%. So you're outperforming the Apple stock by 12 to 14%. So bonds, ETFs, short term, cash, short term, not a bad idea. Not a bad idea. And keep that cash ready because it's my feeling that we may be in a substantial correction. 2022, if we look at that big correction we had, it started in late 2021 and it went until very late 2022. I guess that would be 13 months. And boy, was it painful. The NASDAQ was down 35%. So it's just you have a downward long-term chart, but you can see all these rallies, right? So we had some rallies like in NVIDIA and stuff. You're going to see that, but it's my feeling that we're entering some type of period like this. I don't think it's going to go down 35% on the NASDAQ. Maybe 15, maybe 20, and then we'll kind of correct some stock prices and then move forward. At least maybe I'm hoping that's the case. I'm hoping we don't repeat 2022 because that was a tough year. I must admit, the first 6 months, my enthusiasm did not wane. But once we got into like month 10, 11, I'm like, come on, man, this is freaking getting tiresome. And then it finally broke, and then buying at these periods of time was just awesome because, if you bought 2 years and a quarter ago, your rate of return was phenomenal. So you want your cash so you can start buying, and I'm a dollar cost average guy. You buy when these stocks are really low. So keep that in mind. All right. So that's kind of like my opening. Now I'm going to check comments, see what stocks you guys want to look at, see what you guys are interested in looking at. So Jerry, very good to see you. You want to look at MDB. We'll take a look. Zach, good morning, sir. Dev Q, hello. Sergio, how you doing, man? Thanks for joining. Shadow Guy. On Microsoft, I imagine they could also lease out existing data centers. Well, here's the thing is, and Microsoft has a capacity shortage. So they've actually been trying to build, data centers to build to the demand that they're seeing from their customer. But that demand could go away, and it could drop. And that's what their concern is. So if they built the capacity and they overbuilt and they tried to lease it out, it might be during a period of time when nobody wants more compute, more infrastructure, cloud infrastructure. So that could prove to be really a bad thing. We'll see. We'll see how things play out. I'm sure they got brilliant people over at Microsoft trying to figure out, how do we build data centers and where should we build them? Shadow Guy, you want to see? So we'll look at Microsoft since you brought it up, and then and actually I brought it up. You were commenting. Sorry about that. And you want to look at GM. Glad to. We'll take a look at GM. Genetic Smite. How you doing, man? And you said afternoon, so I imagine you're in Europe. Thanks for joining. Am I okay dropping a stock or two for you to take a look at? Yeah, put it on there, please. DevQ, what do you think of ADMA after the latest earnings? Let's take a look. See what their earnings were about, and then we'll look at the fundamentals of the company. So I'm gonna take a look at a few stocks that I had in mind. If you could give me a few minutes, and then we're going to get into the stocks that you guys wanted to look at. So I did a video on CrowdStrike yesterday, and it was just a quick short. And CrowdStrike's a stock that I've been following for some time. And this is a really good business, okay? There's good businesses that just have too high of a stock price. And that's where I put CrowdStrike. It's a good business. It's growing. It's growing nicely. But it's not a massive business. It's not like Microsoft that is humongous. And when you look at a Microsoft, this is a software company. CrowdStrike's a software company. $262 billion of revenue. Massive. And they're growing at 15, which is incredible. Wow. For a company that big to grow that much. These guys are 4 billion. It's like, wait, you guys are like tiny compared to Microsoft. And you're growing at 29%, which is good. Very good. And when I value this company, the stock price is what you pay. But when you do your analysis and you establish how much cash are these guys going to drive in the future, that's the value that I get. And when I look at their cash only grew 8% in the year they just completed, which ended January 31st, 2025. That's not very good free cash flow growth. So it was a disappointment. So kind of from my analysis, I could see that 8% should be a disappointment to investors that are looking at cash, and the stock's trading down 7%. We're 6 minutes from the market opening. But fundamental analysis, my approach, and there's 1,000 different ways, if not more, where you can invest in stocks. You can invest in stocks just by looking at companies that you really like and you do no analysis. You're just like, man, I really like, you name the company. I like Procter and Gamble because the cereal that I eat, I think they make cereal, or maybe I know they have Tide. I use Tide detergent to wash my clothes, so I'm going to buy Procter and Gamble. Got it. And then there's people like myself that are like, no, I've worked hard for my money and I want to outperform the market. I want to go deeper and I want to analyze companies. So I analyze on free cash flow. And I read books. I've studied other investors, both big investors like Warren Buffett, Bill Ackman, but also other YouTubers who do their analysis and put together my model because I like valuing companies based on free cash flow. And when we look at CrowdStrike, it is a stock, and it's not the first time I'm saying this. I started to really be concerned about, or not concerned, just express that I felt CrowdStrike was priced too high. I think they're priced 60% too high from a stock price. Good business, stock price too high. Because I'm looking at the cash. How much cash are you going to produce, CrowdStrike? This is the true value of your business. How much cash can you produce? They just don't produce a tremendous amount of cash. So that cash forecast discounted by a rate of return that should be applied to a CrowdStrike gets me to an equity value that is far lower than their market cap. This has been my position for 9 to 12 months. I shorted CrowdStrike in 2024. I made a quick 50% rate of return like in 10 days because it was right before they put out that release that crashed, all computers that were running CrowdStrike. So this is fundamental analysis, looking at free cash flow, creating a model that I understand, valuing a company, and then trying to say, hey, what is this business worth based on free cash flows? Then what's the right time to buy? What's the right time to sell? When is the stock too overpriced? Others may invest based on kind of crowd adoption. In the short term, the stock market is a voting machine. The popularity contest will really raise stock prices. Like CrowdStrike is a very popular stock. A lot of people like it. They understand it. Cybersecurity. But the fundamentals are like, hey, that might be the case, but they're only growing cash by 8% this past year. I'm still saying they're going to grow by 15%, their cash flows. So that's a very optimistic point of view. And so that was my basis of saying CrowdStrike's too expensive. And on a day like today where, the market's agreeing with that. And again, I've been saying that for 9, 12 months on CrowdStrike. So that's the basis of how I look at companies. And I thought I'd start there and then look at the companies you want to talk about, but at least you understand where I'm coming from. All right, I'm going to start with my good buddy Shadow Guy wants to look at GM, and then we'll look at Microsoft. So, General Motors. Now, General Motors is a car company. Super low PE, a 4. Oh man, how can a company be priced that low? And analysts believe it's discounted. Now, it's a $45 billion market cap company. Their revenue is $187 billion. They're operating the business quite well. Look at that. Their growth, very good growth. Is management doing their job? Absolutely. I think that the CEO is doing a fantastic job over at General Motors. She's grown the business, man. And my hat's off to her. She's doing a fantastic job. And this business generates cash. Last time I looked at it, they generate really good cash. Look at that. $9.3 billion of free cash The cash margin, oh yeah, that's because it's on sales. But if you look at the free cash flow compared to the market cap, which was 45 billion, you take 45 divided into 9.3, we're going to get roughly 20%, 21%. That's phenomenal free cash flow yield. If I go to the bank and they say, hey, we're going to pay you 21% on your deposits, I'm going to bring all my deposits to that bank. Thank you. What's my limit of how much I could deposit here? Because 21% rate of return is phenomenal. And it's not the first time they've driven all this cash. Okay. Now there's a big giant problem. So if let's just imagine in a make-believe world that General Motors was not in the automotive industry. Let's imagine they were a software company. For that cash flow, they'd probably be worth 200 billion, 250 billion, because just the multiple on software companies is different. Instead, a automotive manufacturer is highly discounted. Investors don't like automotive. I don't like automotive. Why don't I like automotive? You have to hire a lot of employees. You have to open up expensive factories. You have to put a ton of capital into these factories. These factories have a bunch of equipment that's really expensive, very specialized. And the economy tends to dictate how your car sales are going to be. If we're going into a recession, it's not going to be fun for automakers. We're going into potentially a tariff war. That's not going to be fun. General Motors procures a lot of their parts from around the world, a lot of them from China. Now, they may have some advantages domestically. If, a lot of the value of a vehicle is produced here in the US, that's an advantage. Okay. So you'd have an advantage against, I guess, imported cars from Europe and in Japan and Korea, but I don't think we have tariffs on those just yet. We'll see. So as a whole, I think the management at GM's doing a great job, but it's just car companies, they don't get the valuations that other industries do. This stock, really, if I don't even know how to price it. I don't like automotive, but they're being priced at like 5 times free cash flow. That's super low, super low. What's it going to do going forward? I don't know. It did okay in the 1 year. It actually did really well. If you look at the low points and look at the high points, over the 5 year, it's done okay. 52%, small dividend. It's done okay, but it's not an investment I want to make because General Motors is a legacy industry. It's being transformed as we speak. The future is going to be more electrified, and the future is going to have stiff competition from China. China hasn't been a player in automotive sales up until this point. They're coming out with really good EVs, and maybe General Motors can be competitive here in the United States. Most definitely. I don't doubt that. But General Motors is going to have a tough time in Latin America, Europe, other places, Africa, other places where the Chinese are going to start growing. And General Motors has to compete against Japanese automotive companies, European automotive companies, and so forth. This is one of the oldest industries that we get to invest in. And for me, I don't own any car companies. I'm not going to own any car companies. I owned Ford for a while, and the return was less than what I desire. I want better returns. So I got out of Ford, and Ford numbers look great. So for me, General Motors is a pass because I just don't want to be a part of the industry. If you look at the fundamentals, this company is highly discounted. So that's my review of General Motors. And one thing I'll point out, Warren Buffett was asked, is it Some people invest in a company because of the CEO and the management. Oh man, that CEO is excellent. I'm going to invest in that company because the CEO is really good. Well, this proves something that Warren Buffett has stated, which is he doesn't care who the management team is. He really doesn't. The value of the business is the value of the business. What does it do? Is it inherently valuable? Is it intrinsically valuable? In the case of the automotive business, if you look at the valuations of GM, Ford, even Stellantis, and others like Volkswagen, you look at their PEs, you look at their valuations, it proves they're not desirable businesses. You can put the best CEO to run General Motors. And frankly, I think the CEO of General Motors did an excellent job. I could totally see her, unless she wants to be like, I think she's been like a lifer. She's been with GM forever. But she could run freaking Google. She can run Alphabet. She's done a great job. So my point being is management has little to do with the overall valuation of a business. We want good CEOs. We want excellent CEOs. But the intrinsic value of a business is really based on that business itself. NVIDIA has GPUs that are the right product, the right technology for the right time. And their CEO is brilliant. But you could put Mary Barra from General Motors run NVIDIA. NVIDIA would be the same value because everybody wants their GPUs. So I'll make that point quickly. Thanks for asking, Shadow Guy. If you want anything else on GM, please look me up on Discord. You also talked about Microsoft, and I talked about Microsoft. What's going on with Microsoft? It is up 6.61 year to date. It got sent to the principal's office. It announced their earnings, and they said, go to the principal's office because you are spending too much on that data center. And they went to this principal's office and thought about it long and hard and began to say, well, maybe we should lease out some of our data centers and not spend so much capital. Now, I was beginning to invest in Microsoft up until we heard that announcement that they had that, oh man, we're going to spend a ton of money, a ton of capital on that data center. And I'm like, oh, that changes my valuation. I'm out. But now that the stock price has been coming down, where do I sit with Microsoft? Do I think they're discounted? Do I think they are a stock I need to avoid? Let's take a look. It's getting there. I changed the forecast to cash because Microsoft changed the forecast of cash. They said, we're not going to deliver as much free cash flow for a while. It's going to come down. We're going to spend a bunch of money on data center. And it's like, well, your valuation is going to come down then. That's just the way it is. And their valuation went down substantially. Now it's like overpriced by 33%. If I look at the cash value based on their forecast. And I think Microsoft's looking at this going, oh, okay. I'll make another point about Warren Buffett. He became an Apple investor and he started to really meet with the CEO of Apple. And I'm going to guess that he helped that CEO understand, here are the levers you pull to expand the Apple stock price. He talked to him about, I'm sure, stock buybacks, but he also focused on that line, free cash flow. He coached Apple into, you got to really tend to this forecast. And if you do, your stock will flourish. And it did. Apple stock flourished. Microsoft needs a lesson in that area, as well as some other tech companies, because right now the stock is, in my opinion, priced 10% too high. The earnings per share are going to be really good. Their growth is very good for a company their size to grow at the rate that they're growing. Great, growth. But I need the stock to get under $349 per share for me to be interested. I do like the change in strategy in their data center. I think it's a step in the right direction, but they need to keep on that path. They cannot spend gobs of capital in that data center. Because if AI has kind of a pullback, I mean, we're going into potentially a recession, and maybe people are like, I'm not going to pay for no AI app. I'm not going to pay for, I think Amazon wants to charge for Alexa. If you're not a Prime member, they would charge like $20 a year or a month. I forgot what period of time. But Microsoft right now is kind of okay, it's getting there. It's moving down. It needs to move down below $349 per share for me to really think that I'm buying at fair price for me. And but I think the business is phenomenal, right? It's a $2.9 trillion market cap company. They're growing a humongous business by 15%. I applaud them. That's phenomenal. But that's where we're at. I think these stock prices are a little too high. And we'll see how things evolve with Microsoft. Thanks for asking on that. Okay, somebody wanted to look at MDB. MongoDB. Mongo is a software company. They do database. They're kind of a new generation database company. Year to date, they're doing okay, up 9%. For the 1 year, not okay. Opposite to okay. It's not okay. 42% down. Interesting. They have a forward PE. All right. I like software companies. I'm invested in like 8 different software companies. I've been working in the software industry for 20, 30 years. So I really understand software companies. So let's take a peek. I like 20% growth, closer to 21%. It's a little company, $2 billion. We saw Microsoft was at 261. So Microsoft is 130 times bigger. All right. Microsoft's a little bigger, and Microsoft does sell a database. Free cash flow. Look at that. Oh man, they're making free cash flow. Now the trailing 12 months. When are these guys going to announce? They're announcing today after the market closes, right? MongoDB after the close. Oh man. Exciting. So once they announce, we'll see if their cash flow expanded in the fourth quarter that they're going to announce. For now, it's $150 million of free cash flow. They went from negative. Now, this is the evolution of a startup, right? MongoDB started out, they're getting customers, they're just building the business. Everything's negative because they're building a business. And now they have started to go positive cash. Beautiful. They need to grow that cash line. So 150 million. All right. They're growing nicely. I would multiply that times 30. You saw how I do a full model, but I have kind of a little qualifier. I'm like, okay, based on growth rate, this is a software company. What's their gross margin? Gross margins of 74%. These margins have been expanding. You see, from 70 to 74. As they get bigger, they don't have to hire more software developers. And if they're selling to more customers, their margins go up. It's like, hey, it costs us $1 million to build that software program. So if we sell it to one customer, our cost is $1 million. But if we sell it to 1 million customers, our cost is $1 per customer. So the margins are great. So if we get more customers, our margins will expand. Awesome. All right, Mongo, I like your margins. I like your cash. Keep increasing it. We'll be all right. So if I increase that cash, I mean, we're getting up to like 4.5 billion. I don't think that's going to do it. I think people are buying into this stock with the expectation that these guys will be worth a lot more, but it's not on fundamentals. It's more based on these guys are going to be a player in database. They're growing at 20%, a $2 billion business. I'm not convinced. This is tiny compared to the giants in this space. So the fundamentals don't give me the value. that corresponds to their market cap. What do analysts think about this company? Now, there is a little argument between analysts. 31 of them cover it, and the bearish analyst is $220 price target, which isn't too bad. It's only maybe 12, 15% below its current stock price. And the most optimistic is at 440. Now, they're probably basing it on growth. Let's take a look at how their growth is supposed to happen. And they're going to keep growing nicely. But best case scenario, or the scenario these guys are painting, is that in 2028, they'll be a $3.3 billion company. Still kind of a small database company out there. And their competition is tough. Some of the biggest software companies out there. So I think to an investor that really believes in Mongo, I can't argue with you. If you believe their technology has a particular use case that is just, it's exceptional at it, that's your point of view. And I wouldn't try to convince you that otherwise. Fundamentally, it's not worth its current market cap. It's priced too high based on free cash flows. Maybe in a year and they show a track record of how they're growing their cash flow, it could change this investor's kind of forecast. Let's say they move that 150 over the last 12 months to like $1 billion. All right, now we're talking. I think you're worth 30 billion now. But going from 150 million to 1 billion, that's a big, big, big growth. I think, yeah, I just don't see it. I've looked at MongoDB over the last 10 years, actually 5 years. And it never makes it. I see other software businesses that are better priced. For example, rather than CrowdStrike, let's look at Zscaler. They're going to announce after the market closes today, March 5th, after the market closes. And Zscaler is probably selling off because our friends at CrowdStrike are selling off. And CrowdStrike might be the most popular stock out there for cybersecurity. And cybersecurity is a crowded market. There's a lot of competitors, including Microsoft, by the way. Microsoft competes against Zscaler, CrowdStrike. CrowdStrike and Zscaler would say, well, we do it better. And in a way, they're correct. They really specialize. These guys are growing at 30%. Nice, Zscaler. And they're generating, like we looked at Mongo, right? Let's compare this one to Mongo. Mongo was at 18 billion, right? Almost 19 billion. Zscaler is at 29 billion. So $11 billion more. So we'll call it 50% more market cap. Revenue is about the same, right? This is 2 billion. This is 2.3 billion. But we begin to see a separation when it comes to cash and other things. So the growth rate is a little better than Mongo. Gross margins are a little better. And free cash flow is a lot better, 717. So they have higher growth, higher cash, better multiple. They've proven they can generate cash for some time. You see, we're dealing with two software companies. One does database, one does cybersecurity. But this one, fundamentals, right? The fundamentals here are just stronger. And I'm an investor in Zscaler. I like their growth. I like that the stock has been misunderstood. Look at this volatility. Stock market's nuts sometimes. Just discount stocks for no apparent reason, which is great for an investor. Yeah, you can discount great companies and I'll buy them. Thank you very much. So that's MongoDB. Hopefully you found my comments interesting. Good luck with that. Let's move on to ADMA. I see some people are joining. Thanks for joining. We are looking at stocks, and this is the last one before I look at comments, and we can look at more stocks, but this is the last one that somebody asked about. ADMA Biologics is a biopharmaceutical company engages in the development, manufacturing, marketing of specialty plasma-derived biologics for treatment of immune deficiencies and infectious diseases. All right, so this is in healthcare. I like healthcare. These guys announced on March 3rd. And the market liked what they heard. They've done nicely over the 5-day. So the market liked what they announced. This is a $4 billion market cap company, 426 million in revenue. Look at these PEs. These PEs look really rational, priced okay, especially if the company's growing 65%. Holy smokes. Now we're talking, baby. That is growth. What are these guys selling? Whatever they're selling, people want it. Doctors are prescribing it. Look at the expansion on margins. Isn't that a beautiful thing? These guys are like, hey, we're putting in the science. We're investing in the science. Now we're getting more customers, and look at our margins. So they've invested in whatever, I'm going to call it platform or scale that they have. Their margins are expanding beautifully. And right now they have a tiny bit of cash flow. I'm going to go to their investor page and we'll get their cash flow. This looks really interesting. All right. I showed you early on the number one sector in the market is healthcare. And if we got companies like this with a PE of 25 and a growth rate of 65, you got my attention, ADMA. You have my attention. ADMA, Investor Relations. Let's take a look and see if these guys are going to give us a set of financials so I could crack open their statement of cash flows, see what's going on. These guys are biology guys. I'm an analytic accounting guy. So, okay, that looks cool. I'm going to scroll fast because I just want to get to a statement of cash flows. So, balance sheet. And they didn't provide it here. Now I'm going to go to, so investors, SEC filings. And I think we're going to see it here. They didn't provide a statement of cash. Well, that's not good. Come on, guys. I'm going to have to wait for it. So let me try to, so revenues went up nicely. Their cost did not go up in the same proportion as revenues, by the way. That's how their margins expanded. That was a beautiful expansion of margins. And they made a lot of money. Net income, $197 million out of a $426 million number, top line number. That's really, really good profitability. So let's just kind of say that. So I'm going to try to make a quick kind of, back of the envelope kind of call on this, just to see if I want to dig deeper on and analyzing this company. So last year they produced $4 million of free cash. Okay. This is 23. Now we're looking at their financials, 24. Make this a little bigger. And I'm going to get myself out of the way. And okay, so last year they did $4 billion on a year where they were, smaller by 65%, and they didn't make money. So the differential between last year and this year, negative 28, positive 197. That's a $225 million swing to the positive. Nicely done. I'm really liking ADMA. So if I were to say they're going to do like 200 million in free cash flow, roughly, give or take 20%, then I would say based on their growth rate, I'm really excited about the growth. I'd go like 40 times free cash to get me to $8 billion of value. And this business is at 4.24 billion. I'm all over ADMA. I am all over this. This is like, how ants, if you were to leave out like a jar of jelly in the backyard, there'd be like 1,000 ants on it, if not 10,000 of them all over it. Why? They want the sugar, man. Well, the sugar for me is free cash flow and a growing business and an exciting business. It's like just skyrocketing. Look at that. Beautiful. All right. Whoever brought up ADMA, I thank you. I toast you my coffee. That's a good company. That's an exciting business. It's a small cap. I am all over it. I'm going to look into it. Maybe I'll put out a little video. But this one here gets a gold star on my notepad next to me. Nicely done, whoever brought that up. All right, let me catch up on comments. My good friend N. Kiter, how are you, sir? With energy debates with Canada, I thought my hands finally repositioned like VLO. Could be. Just the thing is, oil prices keep going down. I don't know if you noticed that. We'll take a look. VLO. VLO is on the list. Let me catch up on comments and we'll hit that, N. Kiter. All right, so where did I leave off here? All right, so Dev Q, nicely done, sir, bringing up ADMA, Hyper Wizard. It would be interesting to hear your opinion about companies like LB, TPL. Well, let's do it. LB and TPL. Mike, the dividend investor guy. Of course, I have time, sir. DFN would be appreciated. Let's take a look. Is that Devon Energy? I think it is. Take a peek. Genetics Smite. Ha. Well, I'm glad you're tuning in, Genetics Smite. Shadow Guy. Oh, you were saying good morning. Well, there you have it, man. I'm going to reveal, it's a little embarrassing, but whatever. I'm 56. So I know online, like the new generation, like people that are younger than me, they've got like acronyms for everything. And a lot of that's lost on me, obviously. So sorry about that. Bear Light, good morning. Pfizer. Let's take a look at Pfizer. And you spelled my name like I was hanging out with you in Moscow. And I appreciate that. F Junior Pacheco, good to see you, man. You want to look at First Solar? Glad to look at First Solar. I looked at First Solar last week. I liked what I saw. Now, I'll explain what I saw last week. Rotel and Cheese. RPI has good growth, great product. RPI. Let's put that on the list. Rotel and Cheese. Do you look at stock-based comp? Zscaler has concerning amount. Okay, so let's talk about it for a second. So on principle, I'm not bothered by stock-based compensation. So a lot of these companies, especially software companies, you need to attract the best talent. And the best talent, Zscaler is dealing with, they're trying to get talented people. No, don't go work for Facebook. Come work for us. And the person is sitting there going, huh, well, I can go work for Meta, guaranteed great pay. It's going to look awesome on my resume. And they're going to pay me a boatload of money. And then Zscaler is like, hey, but come work for us and we're going to give you stock units, restricted stock units. You have to work here for 4 years to get vested, but come work for us. And that's the payoff. It's not going to look as great, Zscaler versus Meta on your resume. We may not even be able to pay you as much salary. But let me tell you, if Zscaler makes it and we turn into a 200 billion market cap company, you'll be worth 10, 20, 30 million dollars. Then that talented software developer goes to work for Zscaler. That's what they have to do. And the other thing that I like about stock-based comp is that employee is sitting there going, I'm going to work 60 hours a week, because if we make this thing work and Zscaler goes up and triples in value, I just made $1 million. I just made $5 million. I just made $10 million. And I'm going to work so hard to try to make Zscaler the best company possible. So all those things to me are very valuable, inherent, important to especially industries where the talent makes a big difference. You cannot build a company like Meta without talent. You cannot build Google without talent. You cannot build Microsoft without talent. So I have no problem with companies increasing stock-based comp. If you look at the numbers, and we can disagree on it, by the way. I get when people look at the numbers, you're diluting the company. I get that. But I'd rather own a business where the employees are killing themselves to try to make the product better. They're just so freaking passionate about the company because they're part owner. They're like, man, I got to make this work. I personally had a friend that was an early employee at Broadcom, great guy and really down to earth guy. He made a ton of money because he was an early guy at Broadcom. And he told me that for a long time, he made far less money than his peers who went for big businesses, like big known companies. They made better salaries than he did, better pay. He was working like 7 days a week for some time before his kids were born. And then once his kids were born, he kind of like stopped doing that. And so anyway, he made a ton of money on the stock. He wouldn't have gone to work. He was an electrical engineer. He wouldn't have gone to work for Broadcom if they hadn't offered him stock-based compensation. That's just the game, man. Don't hate the player, hate the game. Anyway, but we can disagree on that. But I just shared my point of view on it. Sergio, you're a software engineer. I knew I liked you. I use MongoDB. It's just another database. Nothing special. Thank you, sir. I appreciate that. Cool. Shadow guy. Yeah. My German ETF is doing well. I'll take a peek at it. Not my only complaint is I didn't buy enough of it. European stocks are flying off the charts. I think most people or some investors have noticed. Sergio, Moderna CEO bought 5 million shares. Yeah, I noticed that. That was a big story. That was a big move, huh? What's going on with Moderna? Let's take a peek. That's in healthcare. And Kiter, we were going to look at BLO. And good to see you, in Kiter. El Abdel, how you doing, man? I think it's the first time you post a message in the chat. Thanks for joining. All right, let's take a peek. Let's take a peek here. So I think I'm gonna and just so you guys know, we got some paid subscribers. I appreciate that very much. It pays for some of the costs of running my YouTube channel. I appreciate it, and I prioritize. I go to them first, and then I go to the other requests, just to show my appreciation for those members. And I think that Mike, the dividend investor guy, wanted to look at Devon, and they were going to move to VLO. So Devon Energy, independent energy company. Oil prices are down, which corresponds to this chart. Let me take a peek at oil prices. What the heck's happening with oil? Why is it dropping so much? I can't answer that question. So that affects Devon. It affects oil companies. Devon, I believe, is an exploration company, meaning they go find the oil and they extract it, and in its raw state, they then put it to the open market. They sell crude oil, and then that oil gets into the refining process, and then those refiners sell it as a petroleum product, gasoline, diesel, other products. So oil prices are really dictating what's going to happen with Devon Energy stock. Unfortunately, it's going down. Now we're talking about the big stories out there are tariffs. We got, I mean, what's going to happen with oil? I have no idea. There's no big conflict right now that's going to affect oil prices that I'm aware of. I guess oil prices are dropping because there's plenty of supply. If we're heading into a recession and we have fewer people getting jobs, that means they're going to drive less. I'm just not optimistic. I'm a Chevron stockholder, so I've got some skin in the game when it comes to energy markets. And I'm just not optimistic 2025 is going to be a good year for energy. You might be able to pick up Devon at a discount because it's paying a nice dividend of 4%. I don't know that oil prices are going to get down any lower. I mean, that's pretty low. Mid 60s is a low per oil price. And look at their forward PE, 6.67. Energy companies have with very low PEs. We're not talking about software companies here. And they are, I mean, this energy companies, right? Growth is dictated by the commodity price. If oil prices hit $200 a barrel, these guys are going to explode. They're going to quadruple their business. But we're at 65 or so. So this one here is a judgment call, man. I can show you that this stock's discounted, but it's not about, intrinsic value with an oil company. It's buying at the right times, right? It's not a bad time to be buying into Devon because we're seeing that we're having these strong pullbacks due to that low oil price. Now, my best guess on oil prices is they're not going to get any lower. If we have any kind of shock to the energy complex and that oil price goes up to 75, you're going to make 20% on Devon very fast on appreciation. So those would be my comments there. Now, Chevron, I'm just holding steady. I'm not buying any more shares. I'm not selling any shares. I'm collecting my dividend and just letting it kind of ride. So that's where I'm at with Devon, Mike. And I know you like income stocks. It's looking pretty good, 4%. I don't know that oil prices are going to get any lower. So good luck. And you think about oil is an input into so many products, right? It's not just gasoline. It's like in 1,000 products, it seems. And China their economy is really cranking up. They're going to consume a lot of petroleum. They don't have a lot of natural resources that produce the gasoline and diesel they need. They import a lot of their energy. Well, that's going to put more demand in the market. That might raise oil prices. We'll see. And looks like you've got a comment. I'm seeing the same on Devin. Yeah, it's not a bad move, man. You know, you got to, the one thing about like investing, one thing I would encourage you to consider is try to pick a couple industries you totally understand. Like I've been in oil for a long time. My first job out of college, I was an accountant for a big oil company that got acquired by Chevron. And I got taught the oil business and I got taught the chemical business that is a byproduct of the natural gas industry. And it was a really good education. Nice people, old school business. They taught me a ton. And we implemented new software systems, which was probably the funnest part of it all. And then I moved on to other industries. I worked in pharmaceutical as an accountant controller. We implemented software systems there and worked at a couple of different industries, and then realized I really like software. And then I moved into the software industry as a consultant, and I've worked in big enterprise software for a long time. But my career started in oil, and I've been a Chevron, and before that, I was Unical investor since 1995. So, yeah, I know oil, and I should say I know enough about the oil industry to feel like I can make money investing in oil. So that's where I'm at. All right. I knew I liked you, Mike. You're a CPA. Perfect. Good stuff. All right. So now let's take a look at VLO. So Valero, I think, is so Valero, there's like some big pieces to the whole energy complex. There are the companies that explore for oil, find it. Those are what they call upstream companies. Midstream are the refiners. They refine the product and, get it to market, or excuse me, they refine the product. They take crude. And then there's retail, which is downstream. They're retailing gasoline. We go to the gas station, fill up, and so forth. Valero's in the middle and a little bit of, or the middle and serving the gasoline. So they are less impacted by oil price because it's an input for them. If oil prices on the crude side go up, they double. Well, they double their gasoline price. They're like, sorry, we got to charge more. And that's just the way it is. So they're a little more insulated, which is why they're like only down 0.46, up 0.445% for the year to date. For the year, they're down 14%. Nice dividend payer. Huh. Okay, so we got a stock that sold off 14% over the 5-year. Just a beautiful chart for an energy company, up 90%. Forward P is 16. Why is it higher than Devon Energy? Because they're not subjected to the commodity price. They're kind of insulated, so they're more dependable. And they will make more money when you have high oil prices. We had really high oil prices in 21. Look at their revenue. Boom. Increase because they increased what they charge their customer. So now with oil prices coming down, you see their revenue coming down. Now, can they sustain their profitability and free cash flow? Absolutely. Look at that. Nice. Gross margins are low. The exploration companies, their margins are nice and fat, but it's depending on where commodity prices are, because there's cost to explore and extract in crude oil. That's kind of a somewhat fixed cost. So if you have really high oil prices, let's just say $100 a barrel, man, the upstream companies are just making so much money because their costs are fixed. Where for Valero, their costs are variable. It varies based on that input cost. So these guys are a steady company. I don't know what to say about this. It's a guess, but it looks good that the stock's been sold off for a year. I don't think it's a bad time to buy into them. If you're chasing that dividend, if you want that dividend, it's not a bad time. The stock's been pulled back. And they will be insulated to that low oil price. So for all I know, consumer habits, right? Oil prices are down, gasoline prices are down. So maybe people are like, hey, I'm going to take a road trip since oil prices are down. I want to take a road trip, and they consume more gasoline. We'll see. So hopefully that helps, Nkiter. All right, we took a peek at those. Now let's look at LB. So Land Bridge Company owns, manages land resources to support and enhance oil and natural gas development in the United States. It owns surface acres in and around Delaware Basin in Texas and New Mexico. The company holds a portfolio of oil and gas royalties. So they have a forward P of 41. They're flat for the year. Wow, look at that. 277 higher. They just IPO'd, huh? Okay. So $5 billion market cap. They just do 90 million in revenue. Wow. So you're paying like 51 times more than that. Like 55 times revenue. And so the revenue is here. They're making a royalty. They're just allowing companies to come in and extract oil. So I don't think they have to put a lot of cost into it. So why do they have selling and general administrative costs? So their margin's good. Maybe they do operate the extraction and then they put the oil to market. Okay, could be. These guys are closer to the Devon Energy example we had earlier. It's a pretty incredible rise, right? They were probably unknown. And then once people understood, oh, this is what they do, they went up. But boy, it seems kind of expensive. It's kind of a small operation. And they have a pretty large price tag now. 8 analysts cover it. Some analysts are pessimistic at $25 price target. Best price target is $85. On average, the stock is priced too high by 14%. These forecasts, right, for revenue, this is all predicated on price per barrel, I would think. Those are always hard to figure out. This one here is a pass for me. It seems really expensive. It seems like a surprise is around the corner. It really went up. It IPO'd here in June. It's not, some of the best companies IPO, they get run up and then they crash down. This one here is not the right investment for me. Now, this is an LLC. And would you be... So the other thing to consider is this may be a partnership. So this is limited liability company. Okay. So if this is a partnership, just the ownership is it's handled differently. You're a partner in the business, and you're able to bring forward any losses that the company has. You can put them against your income taxes. This guy's lost some money, so they would actually distribute out the losses so that the partners could then take them against their personal income taxes. But this one here is just a pass. It seems a little too expensive, and I don't know the company all that well, and I have enough energy. I just buy Chevron and I'm good. I own Chevron. I'm good. It's not an exciting industry for me. I'd rather find the next awesome software company, or heck, maybe ADMA, which we looked at, a big biotech company that's growing at 65%. That's exciting to me. Watching oil, not exciting. All right. So that was LB, TPL. Texas Pacific Land. All right. I think there's a new show, right? What is it? Billy Bob Thornton's in it. Land. Oh, man, what is it? Landman, right? I haven't seen it. I don't subscribe to that streaming service, but I bet it's good. And of course, we had Dallas, that famous show. That was about the oil business. And when I was a youngster working at Unical, the old dudes would say, you know how you can make a lot of money in the oil business? And you know how you can make a small fortune in the oil business? And then the punchline would be, you start with a big fortune and you know when to quit. Because oil could be feast and famine. You know, you could be like, oh man, you buy low and then the stock price goes up because oil prices skyrocket. But that's temporary. Oil prices fluctuate up and down. So you have to be smart when it comes to oil, or wise, I should say. PE 69. That's a little bit high. Forward PE not available. They're crushing it. What's going on with these land companies? So they're getting all this land. What's going on here? I don't get it. And they're a $30 billion outfit. I mean, this is a pretty big outfit. Are these guys also a partnership? So profile. So Texas Pacific Land Corporation engages in the land and resource management and water services operations and businesses. So this is more in water sourcing. So they own a lot of land. They have the rights to the water, and they're beginning to sell that water. Well, we can't live without water. So that looks like a consistent business for them. So this doesn't look like a partnership. This looks like a full-blown stock. So this is going to be more of a natural resource utility-like stock. They pay a small dividend. They've done great. Wow, what the heck? This looks really good. It's still going up. So what's the rub here? Why are they so freaking valuable? And what are we looking at paying for this company? So you have 700 million in revenue. It's a $30 billion market cap company. So an investor to be paying 43 times revenue for the company. It's a little expensive. The stock's been going up, so that's part of it. This revenue is growing nicely, but you can see there's ups and downs. It did have very nice growth. Maybe they have a lot of untapped resources that can go to market. Free cash flow looks very good. So if we look at that free cash flow, maybe the company is worth $9 billion to me. I'm going to multiply it times 20. And that's short of their current market cap. Gross margins. So they're just selling the rights. Hey, I'll let you come pick up the water, and it costs very little to sell you the water. Got it. So that looks good. So this one here, I'm not going to be able to value the company at 30 billion. At best, I can probably get to 9 billion. And I didn't even look at their balance sheet. Let's see what that's looking like. They don't have any debt. They have plenty of cash. Okay, good. So this is an interesting business. Obviously, I missed the move. This company was a good investment way back here. And right now, I think the stock's rather expensive. Some investors might invest in a company like this because they believe these resources will be in demand forever, and they're right. We need water, period. Texas is growing. That makes sense. I'm not informed enough and I'm not close enough to make a great decision here. So I'm going to leave that up to other investors to figure out when is the right time to buy and sell here. The fundamentals don't show me that this is a discounted stock. This is out of my zone of knowledge. So it's a pass for me. But if you're an investor where you're like, hey, I really like buying companies that have these natural resources that are scarce and then having control of those scarce resources, I get that. It's not my investing strategy, but I would respect, like, yeah, it makes sense. Especially super wealthy people tend to do that. Like Bill Gates buys some weird investments that are tied to natural resources. I think he's kind of, part of it is a little bit of doomsday mentality. If let's say, AI controls everything in 50 years, we're still going to need water. We're still going to need food. You can't live without that. So for sure, water in 50 years is going to be in demand. No doubt about it. And it's probably going to get more scarce over time because we have more people and just water is a necessity. Thanks for asking about that. You made me put on my thinking hat, although I didn't add a lot of value there. But I would say that in certain situations, if you ask me about a stock and I need to disqualify myself, I will, because I just don't want to make stuff up and say, oh, well, this is what I think. I'll disqualify myself like I'm disqualifying myself here and look at the fundamentals and say, based on fundamentals, this company maybe is worth 9-10 billion and it's priced at 30 billion market cap. I would say that much. All right, moving on to Pfizer. What's going on, Pfizer? I am expecting this stock's going to work in 2025. It's a substantial revenue company, 147 billion. They have $63 billion of revenue. So you're paying 2.5 times revenue. And when you look at their growth, this is what I'm banking on. The market knows Pfizer more recently as the COVID vaccine company, and they had a contraction because they stopped selling COVID vaccines. Totally understand. And they took a bunch of cash that they earned during the COVID years and bought these new businesses. Now those businesses are commercialized and part of their portfolio of medicines they sell. And I think the market's going to wake up to a 20% growing company that is a big pharma company with big margins and say, why is this stock only priced at $26 a share? It should be priced at $50 a share. And I'll say, absolutely, I agree with you, stock market, which is why I've bought shares and I'll continue to own those shares. That is, in a nutshell, my investing story on Pfizer. The fundamentals look good. I think they're headed toward being a 20% growth company. And then the compares are going to look so good. Forward P of 9. 9. Now, a forward P of 9, we saw a car business, right? Undesirable. But this is pharma. Pharma has great margins. Beautiful margins, 74% gross margins and a PE of 9. Oh man, I got to buy more Pfizer. I got to load up on Pfizer, man. The market hasn't quite agreed with me, but that's what makes stock investing so darn gratifying, is when you get something right, you just feel awesome about it. You make a lot of money. And sometimes you have to be patient in a stock, which I've had to be a little patient on Pfizer, but I feel a little bit like, this thing's going to work. The rest of like a lot of other things in healthcare are working. So we'll see how it goes. We shall see how it goes. Thanks for asking about Pfizer. Got me all pumped up about Pfizer, man. Go do some push-ups. First Solar. Now, these guys, believe it or not, now solar was not the coolest industry that people got excited when Donald Trump got elected, because he's probably not going to have, programs to help people buy solar and stuff. I have solar on the house, and we did get a couple things. One, we got a tax rebate. So I was able to hit my personal taxes with, hey, we spent this amount of money on solar panels. Okay, cool. I got a deduction. And second, the utility, I basically am saving like $150 a month every month by installing solar. That's $1,800 a year. I'm saving. Like if I didn't do it, I'd be giving up on $1,800 of savings per year. That's a no-brainer. The solar panel technology has gotten better and better and better, because we got quotes like 10 years ago, and literally we would have to put solar panels on the whole house, and it would have looked really funky. My wife didn't like it, and I agreed with her. It's going to look funky. It's going to look like, it's not going to look good. So now we were able, and we got solar 3 years ago and 2 years ago. We were able to get an array that is like maybe 20% of the footprint of the roof. We put it in the corner of the house where nobody can really notice it. I have to, like, in the backyard, to show people, hey, we have solar. Look over there. And then they're, oh, I didn't know you had solar. And so that's how good the stuff's gotten. So back to First Solar. So they announced, I think last week, and I looked at their financials and I was like impressed. 26%. Hello, 30%. Whoa. Hold on a sec. Pump the brakes. We need to examine this. 26% growth. Okay. Show me your margins. Gross margins, 44%. Okay. Negative cash. Okay, that's a problem. But I thought the growth was really impressive. Forward P of 7. Whoa. They're not going to get any programs, any program assistance. But I think the technology itself is, kind of convincing people that, hey, solar is going to save, like me. I'm saving money. Why wouldn't you want to do that? Yeah, I'm also putting more electricity capacity on the grid, which is good for everybody, but I am saving $1,800 a year. Analysts think this thing is greatly discounted because they're growing. The earnings per share look great. Now, what's going on? What the heck is going on with your free cash flow? And I'm going to keep this open because I'm going to analyze that later. So we're talking First Solar, and we're going to go to their investor relations. I did a short on First Solar. I did a short video, and I was preparing a long form video, and I got busy with some other stuff, so I wasn't able to finish it. Okay, so this is Q4, and I'm going to go straight to the 10K because I'm going to examine their free cash flow. And so financial statements. What I'm trying to figure out is, okay, your cash is negative. Why is it negative, right? And see this line here, this is CapEx, purchases of property, plant, and equipment. It's very high. It's higher than your operating cash flow. So what's the story there? Why are they purchasing so much darn property, plant, and equipment? And it's consistent. They did that amount last year, and then the year before, excuse me. They had a big number last year. It was less because they were a smaller company, and the year before had a substantial amount. So this is kind of like the showstopper for me. There's just too much CapEx that has to go into this business. Now, what I'm not understanding is, why do you have to have so much darn CapEx? Are these guys actually putting the solar assets to use and then they get revenue from them? I'm reading really fast here. So this is looking like a utility company. I don't like utility companies. And it sounds like they are putting money, a lot of capital back into the business, and they're creating more electric capacity and going to market that way. So it's a showstopper for me. It is a pass. They're just not creating free cash flow. And the market isn't excited about them. It's $14 billion market cap. I think they're doing a good thing, by the way. I'd like to see more solar because I just keep hearing that we need more electricity. Great. Well, solar is like a no-brainer, man. Like I see solar all over the place, commercial, residential. I think it's a good thing. So good luck to First Solar. It's not the right investment for me. There's just no free cash flow involved. It's a pass for me. But thanks for bringing it up. RPI. And I'll take a moment to give everybody a quick notice that I have 8 minutes before I have to move on and start my day. So let's handle, I think I've got 2 stocks to cover. I might have a few quick comments on any comments that are out there, but just a quick heads up. Rapid Micro Biosystems. Life sciences technology company provides products for the detection of microbial contamination in the manufacture of pharmaceutical, medical devices, personal care products in the United States, Germany, Switzerland, Japan. Okay. Med device. Whoa. Hey. Whoa. What's going on here? So these guys IPO'd? No, they IPO'd back here. Remember how I made that comment that IPOs come out, they're priced a certain way, and then boom, they collapse. Here's an example. Now, this is a small price tag stock. These automatically make some investors concerned. Like, why is it priced so low? And it's run up for $1, of course. So it's incredible that some investors have made some good returns, but the financials are a little bit like a dumpster fire. Man, look at all those losses, big losses. Yeah, this one's just really small. If it works, I'm sure it's going to be a windfall, but I am concerned. Are these guys going to make it? Are they going to be viable? They don't have a debt problem. They have cash. That's good. Are they burning cash or are they creating cash? Let's see here. Gross margins negative. Now they're burning cash. Yeah, at their burn rate, they have a year of cash left, or they'll have to issue stock, or they'll have to figure something out. Yeah, this is not the right investment for me. I'm basing my investments on a forecast of free cash flow. I can't forecast cash flow for these guys. And the low stock price really concerns me. They didn't get to a low stock price because everybody believed in them. They got there because they were losing a lot of money. Moderna up 6%. Guess the news of that CEO being optimistic about his business and buying all those shares is hitting the wires. Now, when they came out with a COVID vaccine, this stock flourished, to say the least. This was Nvidia before Nvidia, but it's really given up a lot of those gains. Buying into this and then getting out was the key. $12.35 billion market cap company, revenues 3.24. Now, they've been a declining business. So what's the story? What's coming? What's coming that's exciting? They're probably doing a lot of research for other businesses, a lot of laboratory services for other businesses. But man, they are losing money. They probably have a bunch of cash from the COVID years. Let's take a look at that. Fundamentally, I don't like it. I'm already in Pfizer, by the way, so I'm probably not going to touch Moderna. But they have $7 billion of cash from the COVID days. They have a little bit of debt. So they have like excess of $6 billion in market in cash. Their market cap's 12. So it's really like a $6 billion market cap company because you have $6 billion of cash. So it's a good stock to keep an eye on. If there's something that's going to make them profitable and give them a consistent revenue, that would be very positive because right now it's feast or famine. It did great when it had this product that everybody needed. Their vaccine was really in demand. But once we got over COVID, there was nothing there. There was nothing there, unlike Pfizer. All right. So I am going to begin to wrap things up, hopefully in the next 4 to 5 minutes. Let me make sure. Okay. So Sergio. Okay. We talked about Moderna. Gave you my comments there. So Doomy Trash, sorry I can't get to EPA. I just ran out of time this morning. And then Shadow Guy. So you're trying to get into ADMA. Yeah, it seems like a good one. So Dell looks cheap, but I don't like Dell. I didn't like it before we got into this tariff war, but Dell produces most of its product in China. So if we're going to have a tariff war with China, Dell products are going to either Dell's going to see their margins shrink or they're going to have to raise their prices. And that might be tough on their customer. Just some bad things on the horizon. They don't make a lot of money. It's hardware. So I'm not a buyer of Dell. I was actually a seller of Dell. So Omar, so I've been buying into the market. As I see this weakness, I've been buying into healthcare. I've been buying into a list of stocks. So Alarind, event-driven Regeneron. So I looked at Regeneron and it didn't look great. I think I looked at it on Monday. Bear Light. So net cash, yeah, they do have some debt. They acquired a business, and I agree that their debt is a little higher than we would like. But if they're earning $10 billion, and I think it's going to increase to $15 billion in free cash, they'll be able to pay off that debt quickly because they bought a big business that is now going to drive about $5 billion of revenue and drive more profit. So you bring up something that's important to consider on the Pfizer balance sheet. Thank you. All right, everybody. So I've been streaming, ignoring the stock market. What's going on, stock market? You guys probably know what's going on. We got a flat market, super flat. Well, that's not exciting. Now, we've had plenty of excitement. We got Nvidia, man. I tell you, I've been shorting NVIDIA for 9 months, 10 months. And after their earnings, I got out of a short position and I'm like, man, the market's freaking nuts. NVIDIA really put up great earnings. I'm going to stay away from NVIDIA, but I thought to myself, if it gets under $100 a share, I'm buying. It didn't, but NVIDIA's a strong business and we'll see how things play out for them. But other big stocks are working. Microsoft's up, Amazon's up, Apple's down, Broadcom's up, Meta's up, Eli Lilly's up. Nice. That looks good. And let's take a look at what sectors are leading the charge. Materials, discretionary, industrials, healthcare, financials, technology, energy. Man, we talked about energy today. Utilities are down. Interesting. It's that oil price, man. Oil prices are really low. What is going on with oil price? All right, everybody. That was a really, really cool session. Thanks for asking about these stocks. We went over 2, 4, 6, 8, 10, 12, 13, 14 different stocks. Looked at them. Remember, my perspective is free cash flow. Let's take a look at free cash flow and see what these businesses are worth. Are they worth their market cap? Are they discounted? Are they priced at a premium? Just based on that fundamental. That's my perspective, and that's how I view the world. And that's how I'm going to continue to view it because I want to make money every year. And I think if I stick to that recipe for success, I'm going to do that. Thanks for tuning in. I appreciate it. Best wishes on your stocks today. Let's see where this market goes this week. It's been really volatile. And I will try to stream again. I'm thinking I'm going to maybe stream tomorrow night because we have Broadcom announcing their earnings. We'll see if I can pull that off, or I'll have to wait till Friday, which I can stream on Friday evening and catch everything that happened between now and then. So everybody, thanks for tuning in. I appreciate all the views on videos, by the way. It's been a really, really good last 30 days on views. I appreciate all the feedback on videos. And please consider being a paid member of the channel. And please check out the details to see what you get when you become a paid member. And I'd really appreciate your consideration of that. Everybody, have a terrific Wednesday. Good luck to you. Thanks for tuning in.